Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions tonight are Pierre Verster from Protea Capital Management and Alex Duys from Umthombo Wealth. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag Stockwatch. Thank you so much for your time, gents. Starting off with a question here on the JSE. Why is our JSE just simply running and running? This is a very odd thing to see. Will this bull market continue into the end of the year? Indeed, we have reached record levels on the JSE time and time again recently. Alex, starting with you, what do you make of this run?
Yeah, good evening. So I think it's important to note that our market was quite weak heading into the elections. So there's a lot of uncertainty there. And I think it was a very low base that was formed at that stage, right? So since then, at the moment, the perception is that the outcome we got in the election is going to be positive. Obviously, still waiting, of course, actual policies and see if it will translate into economic growth. But for the time being, certainly South African fund managers that were sitting on the sidelines have increased their equity expositions. And that has seen, quite a rally in the market. I think also, not only that, but there's been a couple of improvements as well in our fundamentals. One being, of course, the Eskom. Enormous load shedding that we had last year. We now, call it whatever, how many days now without load shedding. So certainly in the yearly impact, that's going to be positive. We're pretty much seeing a pivot also in Transnet. It's going to be a slog, but seems to be improvements there. And those two components will make a big difference to our economic activity. So more and more, you're seeing sentiment as being a lot more bullish, not only from investors, but also, I think, from general CEOs and so forth. And hopefully, it does lead to further economic activity. And that could lead to, in my view, sustainable rally in our equity markets, because our markets have underperformed for a long time. If you think about it, we haven't really benefited from 2009, the financial crisis, all the money printing and so forth. SA has been a big laggard, specifically in dollar terms. So hopefully our time is now, while the rest of the global markets are looking a little bit full.
Yeah, so the clever money is definitely getting in on the action here. 4 months until year end, JP, do you think that this bull market will continue to the end of the year?
Sure, Zinati, you're asking me to make a 4-month forecast. Oh my goodness, wait. Where's my crystal ball?
Please look first.
Oh, I'm sorry, I don't have it. It's not in these pants' pockets. It's probably in a different pants' pockets. I'm so sorry, but
sure.
to forecast stock markets and prices over the short term is impossible. So I'm being a bit facetious, but what I can say is, and Alex also referred to it indirectly, is there's a big gap between price and value in a lot of analysts' opinion at the moment, with prices on the JSE of shares below the fair value of those shares, of those companies.
Yeah.
So that would imply that there is still decent upside. Whether that will happen in the next 4 months or whether it might happen in 2025 or 2026, we don't know. Mr. Market is a bit schizophrenic, so you can't say what he's going to do in the next 4 months. But I do believe that there's still significant upside if I look at the gap between the prices of most companies, specifically domestically focused shares, SA Inc. shares as we call them, versus the prices. The prices are still low relative to fair value, notwithstanding that they've risen quite nicely over the last 2 months.
All right. Well, let's get into more questions. What are the biggest holdings on the JSE, or the biggest, Naspers? Your view on Naspers, Alex?
Yeah, look, the last few times I've been in a show, I've said I'm very constructive on the business. So the start of Tencent, obviously, that is where the big value lies in Naspers prices. So they recently reported numbers, and for me, it was mostly positive. I think the business is still extremely well positioned. So I think one big component of the Tencent stable is if you look at all the associates, I mean, it's an enormous portfolio they've got there. If you strip that out, the actual core business makes incredible ROEs in Tencent. It's a very, very profitable business with good organic growth prospects. And then you've got optionality in associates. Either they're going to perhaps sell some of these assets, or some of these businesses will become something worthwhile, like we've seen of some of the other assets before, like JD Comic, so forth. So I think there's lots of optionality there. Then, of course, they are doing share buybacks in Tencent, which is very supportive. And then in the Naspers process stable, they're also doing share buybacks. So there's a lot of things that are aligning. And then lastly, if you look at Chinese tech stock valuations, it's extremely attractive relative to US. And also, if you look at Chinese stock market cap relative to GDP globally, is also very, very low. So if any sentiment changes towards China, there will be a major tailwind for these businesses. And as a result, with all the discounts we get in the share buybacks, we think it's one of the few places that's really worthwhile to buy and hold in the South African market at the moment is Naspers process or, or directly through Tencent.
Well, as Alex says, he's constructive on the business. JP, is it difficult to kind of be bearish or just overly cautious at this point on Naspers?
Well, yeah, so my sentiments are very similar to Alex's. If I put myself in the shoes of the bear, it's always good if you have an opinion, can you put yourself in the shoes of people who have the opposite opinion and think through what they are thinking, why they are differing from you? And one of the things is, China is uninvestable, and any business in China actually doesn't have shareholders. It's owned by the Chinese Communist Party, and it's like phantom value. You can never get your value out. You don't have shareholder rights. You only own this shell in the Cayman Islands that have got some contract which isn't worth the paper it's written on, that gives you the right to consolidate the profits in China into that entity. That's the bear argument. But I would say that China is just different. They play by different rules. It's not the type of capitalism that we are used to in the West. It's not the type of democratic, let's call it objective law-based society that we are used to. But it's their way of life. It's their society structure. And I still believe there's enough scope to participate in the economic activity of companies that operate in China, and that you will get the fruits thereof. There will be share buybacks. There will be dividends. And a company like Tencent has shown that in the past. So I do think that some of the bears are a little bit too negative Chinese companies, including Tencent and therefore Naspers and Process. And I'm more on the bullish side, similar to Alex.
All right. Well, Woolies, and actually, like a lot of people, as you said, some of the stuff that we do have going for us, Alex, the green shoots that are coming in terms of the South African economy, that's all obviously benefited the retailers. Has Woolies participated in that positive sentiment?
Look, so obviously Woolworths is predominantly exposed to South African middle and high LSM consumer. Obviously, it also got a business in Australia, but let's focus on the SA components. So if you think about fashion or clothing, they have struggled there of late. Now, the question is it temporary or structural? So, I mean, the last couple or so years, the managing director of Fashion Mining has actually done a quite good job there. If you look at the reduced space and increased trading densities, and it's been selling at higher GP margin, but because of the weaker consumer demand, we have seen a little bit of a drop there. So I'm more of the camp that it's probably more temporary as to structural. So if there's a bit of improvement there, that will be very positive for the business because it's a big component of profits. Food, it's a world-class business. And that is also quite in a way reflected in the valuation and the margins and so forth. But if SA connectivity can pick up, I'd imagine that food will be able to grow volumes again. So that's also relatively positive, or potentially positive, so rather say. I think Australia's got problems. I think that market, consumers over-indebted. You got perhaps a housing crisis bubble there, perhaps too much debt. I'm a bit concerned there, but luckily they don't have exposure to David Jones anymore. But overall package, I would say it's okay. It's looking more interesting for me than it's been for a while, Woolworths. I would like perhaps to have a stronger balance sheet than this, but I think the cash generation is still respectable, and and they're trying to do many things, a lot of capex, share buybacks, dividends. There's an interesting one, but if economic activity picks up and sentiment improves, Woolworths will follow.
It's quite interesting also, I mean, the analysis that Alex gives, that there's still obviously pressure in Australia, but with the kind of positivity in the numbers that we are seeing in South Africa, could that be worth holding the stock, JP, even with all the other pressures?
Yes, I do believe there is a case being made for Woolies. The upper end consumer in South Africa has been under significant pressure. So everything we've seen of late, less load shedding, interest rates might come lower later this year. It looks like we are going to go into a lower interest rate cycle, which is good. That means that the higher end, which is people who have mortgages and car debt, are going to benefit the most from lower interest rates, and that's Woolies' core target market. So that would be specifically good for food because it's a premium product. On the apparel, it's an interesting one. I also agree that Woolies has done a lot right and they've sort of fixed that business. But the likes of Shein and some other e-commerce players, there's a lot of competition now. And Woolies, on the one hand, they're not quite as fashionable as some other players are. Let's say Truworths. Truworths, if you want a very nice evening dress, you'll probably buy it at Truworths, not Woolworths. And at the other end, if you think about the basics that Woolworths are very good at, they are quite expensive relative to these other options now, which are much cheaper. Yes, the Woolies basics are maybe better quality, but people might be scratching their head to want to pay such a premium for quality basic apparel. So it's an interesting one. I'm not quite sure if the apparel business needs to do some more to fix it, and then the food business just mustn't put a step wrong. And if you look at the current share price, I think also it's reasonably priced. And any upside from here will probably be driven by an improving macroeconomic environment in South Africa.
All right. Gents, more questions. This one, JP, you can close your eyes, close your ears. We're talking about Capitec. Alex, is Capitec a buy at current level to keep over the short to medium term?
Yeah, look, Capitec is one that a lot of long-only managers have been scratching their head for quite some time. So it's obviously a fantastic business, right? Everyone knows that, and the growth has been phenomenal, and the story is incredibly successful. And you can still see many reasons to be bullish on account as well, to be honest. But the valuation does stand a little bit out, specifically relative to the rest of South African Inc. And I think that's where a lot of managers are trying to think, okay, well, they can probably make more money by not buying Capitec and perhaps buy some other South African Inc. shares. And that strategy has not really worked that well of late, or quite frankly, over the last 15 or so years. But from this base forward, I'm relatively comfortable not being Capitec at this moment because the valuation, I think, is a little bit more on the fuller end of scale. But I most likely will be proven wrong from a regional side. We'll probably see continuously strong earnings. They've got huge optionality now. They bought a funeral business from Sanlam, an insurance side of the equation. They're doing incredibly well in, the transaction side of the business. And that transaction side of the business, I think, is actually very, very valuable. Probably a lot more valuable than the simple lending side of the business. So it's a tough one. I would like to buy it at a better price. I think that's pretty much my point.
Okay.
At these levels, I will be more cautious, as there could be a 20-30% pullback, in my opinion.
All right. Well, let's go into HCI. Could the wise folk indicate whether the HCI price is purely dependent on market performance? I'm not sure if that's the broader market or JB, any insight?
So it's an investment holding company. So the share price of HCI will be determined by the performance of the underlying investments in which HCI is invested. And then to some extent, you can say the widening or narrowing of the investment holding company discount. And if you look at the major underlying components, the major underlying businesses that they've invested in, you have OSIN Gaming, which is a cash generative business, mostly land-based casinos. The problem is we've seen the growth of online betting and online gambling take a significant share away from land-based casinos. And Toggle, unfortunately, was behind the curve there. That's still very cash generative. Then you have Southern Sun, the hotel business. That's chugging along very nicely, decent occupancies, and they've got a lot of hotels in the Western Cape, which is doing better than the rest of the country. So you can tick that box, that's doing well. And then one that they've got some smaller listed companies, for instance, Frontier Transport and E-Media Holdings, and there's a little property business as well. But the other big one that's not listed is Impact Oil and Gas. And there, the big value is the oil fields in Namibia, near the border with South Africa, and what might happen to those fields. A lot of oil majors are very excited about those oil fields. Still very early days. It's going to be many years before oil is actually pulled out of the ocean. But HCI and Impact Oil and Gas have done a very good deal to de-risk that and not needing to follow up with more capital, but still maintain their exposure to Impact Oil and Gas. So if you put all of that together and some other bits like HCI Coal and the properties and whatever, I do get a fair value, quite a bit above the current share price of 180 to 190 Rand. And the main determinant, I would say, at this point in time, is what's going to happen with Impact Oil and Gas and how lucrative are those oil and gas fields just off the Namibian coast going to turn out to be.
Wasn't there actually some pressure on the stock when it, in connection with Impact Oil and Gas last year? Alex, do you think investors are over that?
Look, so there were certain investors invested in Oscar thinking that they might actually exit that position and give special dividends back to shareholders. So when they then came with the announcement that they're going to do this new funding agreement that Jean-Pierre refers to, meaning they're going to be a long-term holders, I think that spooked some investors and they sold out, right? So, but I think the underlying value does seem immense. But just remember, this is still a greenfields operation, so things can still go wrong. You know, the delays could be material delays and so forth. But so far, with the evidence we have seen thus far from communication from management, looking very, very promising, and could be materially higher than the current share price. So we are holders in Oscar. We like it. We're willing to invest in it. Obviously, you do have some risk from environmentalists, once again pushing back against this type of deal being concluded and so forth. But deal, the actual oil construction and so forth. But I think, you know, Oscar is certainly an interesting play for us in South Africa. Huge margin of safety in our view. And it was actually my stock pick perhaps a month or so ago. So I like it.
All right. Let's get into aluminium. Can the panel give their view on ULAN over a 2 to 3 year horizon? Yeah, I understand that the stock also got hit. I think, when was it, last week or 2 weeks ago when it released its results, but seeming that it's come back a little. JP, what do you make of ULAN?
Sure. ULAN might be a value trap. It's looked cheap for many years. I can remember 10 years ago, someone asking, oh, it was trading below NAV, and I wouldn't be surprised if it was trading close to this price. And the question was, isn't it so cheap? Shouldn't we buy ULAN? And now 10 years later, we're back to where we started, and you've made no money over a decade. So that shows you, when looking for shares, don't look for the cheapest shares. Look for the best value shares. And normally the best value shares have got higher than average quality. The business is of a higher than average quality. It's got pricing power, and you can with reasonable certainty say in the next few years, the profits are going to grow. They're going to be higher, hopefully even higher than the inflation rate, because they've got pricing power. You can't say that with ULAN. It's a commodity business. They buy bark salt, the raw material, then they pay for electricity, and we know that's an issue in this country. And then finally, they can make aluminium, some specialized products, some rolled products, and then they need to compete against the whole world to do exactly the same in a commodity product. And I don't like those dynamics. So it doesn't matter. It almost doesn't matter how cheap ULAN gets. It's on my do not touch pile because of the quality or lack thereof of the business economics.
Yeah. Alex, on your side, and quite interesting what JP is saying, that it hasn't really, it's been looking quite cheap for over a number of years now. And the viewers asking what it could do in the next 2 to 3 years.
So I've been in the market now for about 16 years. Incidentally, in 2008 also, Eskom problems really started to burst, right? And go look at ULAN share price since 2008 until now. It's been a disaster, as Jean-Pierre says. So, you know, ROEs in a business has never been good. I don't think it's ever been above 10% that I can recall. So as a result, they continue to destroy capital. You know, they just don't have the ability to earn the cost of capital, which they'll never trade it as NAV. So that's where the value trap comes in. So when you tell me the stock is cheap relative to NAV, remember, it doesn't generate enough returns to justify to trade it as levels. Now, where ULAN does become interesting is there could be a period where the stars align for them. Call it a 6-month or 18-month period where you can make super profits. You know, but other than that, this is certainly not a buy and hold stock in my view. I think the quality is, of course, just not there. And I think SA economy and manufacturing is just not competitive as it used to be.
Yeah. Gents, let's go into Santova. Quite an interesting one here. On the Santova website, it says that directors own 21% of the company. This is obviously good, but only possible in smaller companies. Do you know of any other companies with large director shareholding. Yeah, firstly, I guess maybe just comment on that shareholding that we're seeing there on Santova, JP.
Yes, it's true. The founders and directors of the business still actively involved. They've got significant stakes. As you say, it's easier with smaller companies. But if I quickly go down the list, I'm looking at the list on the JSE to see which companies catch my eye where directors have significant shareholding. I would think companies like Shoprite, for instance, even though Chris Duys is the non-executive director, that's one. Another one is Aspen. Stephen Sard and his management team have a significant shareholding. Discovery, Adrian Gore's got a significant shareholding there. And as you go down the list, there's quite a few others. So there are, even under the larger companies, a few examples of directors having significant shareholding, and that aligns interests. I also prefer directors to have significant shareholding in the companies that they lead. It's not the only filter you can use. And there are companies where directors don't have a significant shareholding and they also tend to do well. But quite often it is so that if you have significant director shareholding, on average, such companies perform better.
Okay. One last question before your stock picks quickly. BHP, is there value at current levels? What did you think about the latest results, Alex?
Yeah, I mean, BHP obviously being a diversified mine, if you look at the EBITDA margins over time, it's relatively stable. It trades within a range, so it's certainly the quality business. But to be fair, they have also benefited from a very strong iron ore price over the last 15 or 16 years. So it's unsure how that margin would look like if you do go into call it a bear market, sustained bear market in iron ore. They're also trying to reconfigure the portfolio more into copper, where they've got world-class assets there and on a cost curve, and got very long life of mine. So I think they're very well positioned there. The nickel side of the equation is not looking great, but then they've got the steel making as well as energy coal, which will probably be interesting how they play that over time. But overall, Billiton is pretty much as good as it gets if you're an South African investor looking for diversified miners. This is the highest quality counter. There is, of course, corporate action risk. We know they are in the market for Anglo American. So that is a bit of a risk I would be cautious about. But you can bet your bottom dollar, if the cycle turns in their favor, they do well. And if the cycle does not do well, they will do relatively better than some of the others, in my view. So Billiton is a safe place to be if you want to be invested in diversified miners. But be cognizant, you are taking a big bet on iron ore, and iron ore is dependent on China. China economic activity doesn't look great at the moment.
All right. Well, talking about pockets of safety, let's get to your stock picks for today. Gents, JP.
I'm buying a London-listed sports and leisure and apparel retailer called JD Sports. They sell, as I say, a lot of shoes and apparel, specifically for active people. And it used to be a UK business mostly, and then they expanded into the rest of Europe. But the last few years, they've expanded aggressively and successfully into the US. So it's now a significant global apparel business. And the latest acquisition is Hibbett, which is a apparel chain that specializes in expensive shoes, trainers and other sports shoes in the US. And they bought that for just over $1 billion without issuing shares. So they put some debt on the balance sheet, but I think it's a good acquisition. And in a recent update 2 weeks ago, JD Sports said that the US operations are growing very nicely. So it looks like it's one of a few companies that have expanded outside of the UK into the rest of the world and the US successfully. So that's why my stock pick is JD Sports.
All right. Alex, what are you running to today?
Yeah, so we've seen a lot of the JSE education counters reporting. So Study was one of those yesterday, and I walked away there quite positive. So I think Study has got quite good top line potential, with that meaning they can grow actual number of learners, as well as increase the margins. If you look at the EBITDA margins, around 29%, that they were guiding between 29 to 33, perhaps even 35% of the time. So if you've got a good top line, worth expanding EBITDA margins, that means a very strong bottom line number. But very importantly for Study also, they've got very good cash generation. If you look at the cash conversion, relative to EBITDA is like over 130%. And that's because the J curve is a lot quicker in Stadio, which is predominantly distance learning, compared to, for example, something like a Cura, which is building schools. Right, so that means shareholders will get big dividends, in my view, as well in Stadio over time. So I think they're very well positioned for growth. I think the valuation is still relatively fair. But specifically the cash earnings, I think, is going to drive a lot of share buybacks and dividends over time. So for me, one of the few growth stocks in South Africa, and as a result, I like it.
All right. Well, gents, let's skedaddle out of here, even though we're not wearing our JD Sports apparel. Thank you so much for your time and for your analysis today. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Alex Duys from Umthombo Wealth. Up next, The Close. Stay tuned.